waking up to find 47.5% of your life savings gone. That sounds like a nightmare scenario, right? No, this isn't some dystopian movie plot. It was the cold, hard reality for thousands in Cyprus in 2013. But one thing always confused me about this whole crisis. I mean, how did a country's entire banking system just decide to take its customers' money? And why were Russian oligarchs suddenly at the center of this European financial drama? So let's tackle that question. In this video, we're going to explore just how the Cyprus banking crisis unfolded and why people's bank accounts were raided overnight. So buckle in, it's going to be an interesting one. So before we go into the details, there are a couple of basic facts that we should be using in this video. The core of this crisis was something called a bail-in. Unlike a bailout, where external money, usually from the government, is used to save a failing bank, a bail-in uses the bank's own resources. And by resources, I mean the money deposited by its customers. By the way, banks are supposed to be the safest place for your money. So the choice to just confiscate deposits always seemed insane to me, but I digress. The plan targeted anyone with more than 100,000 euros in their account. So the more money you had saved, the more you were about to lose in this financial nightmare. Okay, let's get started with the unprecedented deposit grab. For anyone with savings in the Bank of Cyprus, the country's largest lender, the news was catastrophic. Initially, the plan involved a levy on all bank deposits, big or small, which caused a massive public outcry. But the revised and final plan was far more surgical and brutal. Deposits under the 100,000 euro insurance limit were supposedly safe. However, for any amount above that threshold, the government implemented a forced conversion. A staggering 47.5% of uninsured deposits were confiscated. They weren't just erased. They were forcibly converted into bank equity, or shares in a bank that was, for all intents and purposes, insolvent. Imagine having 200,000 euros saved up. The first 100,000 were safe. But of the remaining 100,000, you would instantly lose 47,500 euros, replaced with near-worthless bank stock. This wasn't a tax, it was a seizure. This concept, the bail-in, was a radical departure from how previous financial crises in Europe had been handled. It set a terrifying precedent, suggesting that in a crisis, a person's savings account was no longer sacred ground, but could be used as collateral to save the very institution that was supposed to protect it. The government and international lenders argued this was necessary to prevent a total collapse. But for the individuals and businesses who saw their capital vanish overnight, it felt like state-sanctioned theft. The psychological shockwave was immense, shattering the fundamental trust between citizens and their financial institutions. Now, you might be wondering why Cyprus, a tiny island nation, had such an oversized and fragile banking sector. A big part of the answer lies with its connection to Russian money. For years, Cyprus had positioned itself as a financial haven, offering low corporate tax rates and lax regulations that were particularly attractive to wealthy Russians looking to move money out of their home country. It became a primary offshore hub for Russian oligarchs and businesses. By the time the crisis hit, the numbers were staggering. Estimates from Moody's Investors Service suggested that Russian deposits in Cypriot banks amounted to around $31 billion. This massive influx of foreign cash had fueled a banking boom, with Cypriot banks offering high interest rates to attract even more capital. The banks then used this money to make risky investments, including a massive purchase of Greek government bonds. When Greece's economy imploded during its own debt crisis, the value of those bonds plummeted, leaving Cypriot banks with billions in losses and a gigantic hole in their balance sheets. The Russian connection became a major sticking point in the bailout negotiations. European leaders, particularly in Germany, were reluctant to use their taxpayers' money to bail out a system that they viewed as a money laundering hub for Russian oligarchs. This sentiment heavily influenced the decision to impose the bail-in, as it was seen as a way to make these wealthy, and primarily foreign, depositors bear the cost of the bank's failure. It was a politically convenient solution, but one that also caught countless ordinary Cypriot savers and businesses in the crossfire. As news of the initial bailout plan broke, the government took a drastic and desperate measure to prevent a complete bank run. They declared a bank holiday. But this wasn't just a one-day affair. The banks in Cyprus shut their doors for nearly 2 weeks. The entire nation was thrown into a state of economic paralysis. Imagine a modern economy trying to function without access to its banking system. It was chaos. While the banks were closed, strict capital controls were imposed to stop money from fleeing the country. ATMs were still operational, but cash withdrawals were severely limited. At first, people could only take out a few €100 per day, and soon that limit was slashed to just €100. Lines at ATMs snaked around blocks as panicked citizens tried to pull out whatever cash they could. For businesses, the situation was untenable. They couldn't pay their suppliers, they couldn't pay their employees, and they couldn't process transactions. Supermarkets started reporting shortages as supply chains ground to a halt. Many businesses began refusing credit card payments, demanding cash that nobody had. The economy effectively reverted to a cash-based system, but the cash itself was rationed. People resorted to bartering or relying on personal IOUs. This 2-week shutdown wasn't just an inconvenience. It was a complete strangulation of economic activity, pushing an already struggling economy deeper into recession and leaving a lasting scar of fear and mistrust. The whole crisis came to a head because of an ultimatum from the Eurozone. Cyprus was on the brink of bankruptcy and desperately needed a financial lifeline to recapitalize its failing banks and keep the government afloat. The Troika, consisting of the European Commission, the European Central Bank, and the International Monetary Fund, offered a bailout package. The amount on the table was €10 billion. However, this rescue came with incredibly harsh conditions. The Troika demanded that Cyprus itself come up with €5.8 billion to contribute to the bailout. It was this demand that directly led to the infamous bail-in proposal. The international lenders were firm. No contribution from Cyprus, no bailout, and without the bailout, the Cypriot banking system would collapse, likely forcing the country to exit the Eurozone and face complete economic ruin. The ultimatum put the Cypriot government in an impossible position. Their parliament initially rejected the first proposal, which would have taxed all depositors, including small savers. This act of defiance was celebrated on the streets of Nicosia, but sent shockwaves through European capitals. For a few tense days, it looked like Cyprus might just crash out of the euro. Faced with financial Armageddon, the government had no choice but to go back to the negotiating table. The revised deal, the one that targeted only the large depositors, was their only way out. It was a bitter pill to swallow, a surrender of economic sovereignty in exchange for survival. The Eurozone's hardline stance was a clear message to other struggling member states. The era of no-strings-attached bailouts was over, and from now on, bank investors and large depositors would be on the hook when things went wrong. The final toll of the crisis was a story of massive wealth destruction. The most direct and brutal impact was on the depositors themselves. The 47.5% levy on uninsured deposits in the Bank of Cyprus, along with the complete winding down of Laiki Bank, the country's second largest, wiped out an estimated €8 billion in savings. Let's try to calculate that. Think of a small business owner who had €500,000 in the bank as working capital. 100,000 was safe. Of the remaining €400,000, a staggering €190,000 vanished overnight, replaced by bank shares that were effectively worthless. This wasn't just paper losses. It was the destruction of real capital that businesses needed to operate and individuals needed for their retirement. The broader economic impact was devastating. The capital controls, while preventing a total collapse, choked the life out of the economy. In 2013 alone, the Cypriot economy contracted by a painful 5.9%. Unemployment skyrocketed, peaking at over 16%. Thousands of businesses went under, unable to survive the credit crunch and the collapse in consumer demand. The crisis triggered a deep and prolonged recession that the country is still recovering from. The total wealth destruction went far beyond the money seized from bank accounts. It included the lost jobs, the failed businesses, and the shattered confidence in the financial system. It served as a brutal lesson in the fragility of modern banking, and a stark reminder that when a crisis hits, the rules you thought were solid can be rewritten in an instant.